video version of the Meaningful Dividends podcast as Dean joins me today to give a market update. Dean, the old adage, sell in May and go away. I say old adage because that was
Been around a long
probably a big
time.
deal. It's been around a long time. It's probably a big deal for you. Not sure the data holds steady that that's what we should always be doing. But give us just some perspective going into May. What has been the prevailing wisdom over your 30 years in the
Well,
business?
the fact is, when I started, that was it's not an acronym, but it's a common saying, right?
Yeah.
And the fact is, the markets do what they're going to do right up until they do something different, right? So I, I would say one of the things I'd appreciate about having a research scientist on our team is we focus on the data. And I think that's over the years, I've just found that's the best effort. You get a lot of impressions. And the fact is, if tomorrow something comes out that's major, the markets are going to react, whether it's COVID or an oil embargo or a war or a new technology that just revolutionizes the world. Maybe Google comes up with quantum chips. Something happens to really change the playing field for the chip market. And markets are going to go where the money takes them. And that's driven more often by data, not by gut. So
So many good tidbits there. I think that idea of just like that markets are different than they were now, right? So being driven by data. Markets do what they're going to do right up until they don't, I think is a great point. There's always the potential for the next thing and to upend whatever we're doing. I think those are just there will always be something and it will always be changing.
well, and frankly, that's the opportunity in the market. That's why we're in the markets, right? Because
Mhm.
you know, companies are in business to make a profit. And so they are all motivated. They know what's going on and they're motivated to grow their business and seek out bold new worlds, bold new markets, right? Not to wax sci-fi-ish, but that's really what they do. And so being an investor, that's critical. I mean, you have to understand that no one disaster and no one positive announcement makes a market. That's why we're active. We're constantly working to make sure we are, weeding the garden per se, getting rid of the losers, the ones that can't keep up, and adding those things which are productive.
So I've been getting a lot of calls just in the last couple weeks of people
Mhm.
that say something along the lines of, should I be taking money out of the market right now? Things might feel a little toppy. Should I be taking my RMDs now? Should I wait till the end of the year? What's the best way to do this? And so I wanted to start our conversation today by putting up a piece of data because I like data. This is the Consumer Sentiment Index. So
Yeah.
how consumers feel about the markets versus actual S&P 500 market returns since I think that comes back to the early 90s or the 80s when this was first being tracked. And what jumps out early are two things. One, the S&P 500 generally moves up and to the right. We know that. And the other thing being that the consumer sentiment does not. And especially since 2020, the consumer's feelings on the market has become very decoupled from market performance, right? And so for a while, and what I mean, I know you're thinking about that, it was almost a contra indicator, right? When consumer sentiment dropped and was at lows, you saw this drop, market would follow, you would buy, and then it would recover, and the consumer's feelings would go along with it. There'd be a recovery. What we're seeing are drops and more drops and more drops. Even as the market tends to rally, consumers are still feeling negative about it, kind of across the board. Now,
Mhm.
that could be speaking to a number of different things, but I'll pause and just give you a chance to come in with your thoughts there, Dean.
Yeah. I mean, I'm sure you're thinking about these too, because we've talked about this a lot, but it, it's the decoupling of consumer sentiment from market performance has a lot to do with the fact that the stocks that have been performing tend to be focused on new areas of technological advancement, right? And so while you might have a consumer worried about losing their job to an AI replacement, that could impact consumer sentiment. Fact is, that's good for companies, maybe not good for that individual consumer and their outlook on employment. When I teach, I've got a lot of young students, and I think those college student job seekers now, probably rightfully so. A lot of them are nervous about these new technologies because the paradigm's shifting about what is going to be of value in the future. And so that may show up as negative consumer sentiment, at least in that demographic, or maybe those impacted by that. But the reality is, it's a tremendous opportunity, probably for both groups. I think you and I are both in the camp that, again, motion creates opportunity. When there's disruption like this, there are opportunities for companies to take advantage of that.
Absolutely. I think the idea, because I mean we're human, right? We are subject to the same emotions that any of our clients would be. And I think we feel this just like anybody else, that things look expensive when you go to the gas station or when you go to the supermarket, and there's concern about disruption, there's concern about the world that we're gonna send our kids off into.
Mhm.
But when you peel back what the market is actually doing and focus on the data, I think it tells a different story. And I wanted to show two additional kind of slides here of why we're continuing to be invested and invested on somewhat of an aggressive basis. Like, I mean, we're protective always, but we see strategic areas that we want to be taking advantage of. Let me pull up another slide. We often call these just our style boxes. And this is looking at, we're just going to focus here on the top right now. We talk about bonds maybe in a sec if there's time, but the top is showing Russell US indices. So these are major US indices, and it's broken down into 6 different categories, and so it kind of blends into 9. But you have large, mid, and small, and growth, blend, and value. And up and to the left, large growth has traditionally driven US markets over the last few years. You think all of your large growth type companies,
Certainly.
those have been big winners, and they have not been this year. This year, large growth, it was negative up until just a week or two ago. We've had a great rally, but it's just over positive. Same with mid cap growth. But as you become more value oriented, and as the companies tend to get smaller, small cap value has had one of its best years in recent memory. One of the things that this speaks to and that we really try and draw out is that there are opportunities in the market for the investor that's willing to go after them and shift. It's not necessarily like a buy and hold, because if you could have only bought and held over the last 5 years, you'd probably still want to have been in large cap growth, and that's fine.
Yeah.
But things are constantly changing, valuations are constantly shifting, and the opportunity has been for, perhaps in retirement accounts where there's no tax consequences, to move to some of these undervalued areas in the market, which are seeing more momentum at this time.
Yeah. I think, y- I mean, you and I know, and I think our clients know, particularly in their retirement accounts, we've been more active. And this is exactly why. When you just stop and look at the data, I think this is a really common phenomenon that areas of the market move, especially in the early months, they move before anybody really notices. If you're not paying attention to this on a weekly basis, right, or on a regular basis, you get lost and you don't understand what's actually happening. And so that's the value of, our very aggressive data gathering, analytics, this weekly reviews, weekly calls, because it just allows us to stay on top of things that the average person that's just going to, own a few stocks or maybe trading in between their regular day job, they're just not going to have time typically to pay attention to these things. And I think we've been very fortunate to have caught some of these trends because
Yeah.
we've been able to make adjustments on an ongoing basis, and it's worked very well.
Yeah. So the next piece of data that I want to show and talk about is within the S&P 500 and the earnings that are going on there and like what's driving markets. One of the things that makes this data jump out into my mind is that we saw an aggressive sell-off during the start of the Iran war. And interesting, when you look at what drove most of that sell-off, it was a compression of multiples, right? So instead of paying 25 times earnings for a company, companies were getting revalued to 20 times earnings. And then the rebound was actually not driven. So we've seen a rebound in the last 2 weeks, one of the best rebounds we've seen in the last decade. But that hasn't been driven by an expansion of multiples, but actually by a surprise in earnings for most of these companies. So let me show this here. This is a piece of data looking at Q2 earnings relative to analyst expectations. So important to recognize that markets are always forward pricing. The price of a company is not really what it's worth today. It's what people think it's going to be worth in a month, in a year, in 10 years.
Yeah.
It's into the future, depending on how durable that business is. So when valuing companies, analysts spend a lot of time saying, what are the earnings going to be? A stock moves one direction or another when they announce earnings, most often when analysts aren't correct. So if an analyst says they think it's going to earn $1 per share and it does, the price will sometimes stay static.
Yeah.
But when it surprises is when you get a move. You want to say something on that?
Yeah. I mean, and what we notice is it's not even the number, it's the call afterwards and the expectations that company management sets for going forward. To your
Sure.
point, markets are discounting measures. They're always looking out. And so this is a hard thing for a lot of investors who are newer that aren't used to going through earnings cycles. They don't understand why a company can have record earnings and the stock can go down, or earnings are flat or mediocre and the stock rallies. And a lot of that is on that expectation. You can't justify some of these big tech earnings if you expect their earnings are going to stay static. I mean, they're making billions of dollars, and that's great. But if those earnings are going to stay level for the next or decline in the next 5 to 10 years, investors are going to be quick to discount that cash flow. Most of our growth companies, the large cap growth, are pricing out growth over the next 5 to 10 years and looking for increasing earnings at an accelerated or at least a consistent growth rate. And that's why they're quote worth, or the model puts them at a price now. So it really is that earnings call that is a big differentiator now that, I don't know, 30 years ago, I suppose it was always sort of that way, but now the earnings number, analysts are pretty good at predicting earnings. What they're not as good at is telling you what management's going to tell you the future looks like.
Well, what we're seeing, you say analysts are pretty good at predicting earnings, but what we saw in this latest cycle, so this data is as of April 30th, 2026, is that around 80% of S&P 500 companies were surprising to the upside on earnings, right?
It was
And
outstanding.
especially in areas like technology, where it was, well into the 90s, that we are having just good earnings within companies. Interestingly enough, kind of tying this back to the data we showed at the beginning, the types of companies that were most likely to see downside on earnings expectation was that consumer discretionary. Those who might be affected by consumer sentiment of just like, how's the consumer feeling? How are they spending money? Most susceptible to inflation, those types of things. Those companies were the ones most likely to have reported a negative earning, even though, over 50%, 60% were still showing a positive surprise. It's when we look at data like this, when we're seeing that there are opportunities in the market in the value or the smaller company space, that even large companies are showing good, robust earnings, that we have confidence to stay in the market and continue to invest, where the data is leading us. It looked like you were looking something up there.
Well, I wanted to get the number right, but one of the things, back to our point on this large concentration in these others, consumer discretionary is only 11% of the S&P 500.
Sure.
So that's another reason why you have this. You can't have very negative consumer sentiment. The stocks that are really impacted by that, about 11% of the S&P 500.
All right, Dean, that was the data I had for today. Anything you want to add?
No, it's great data. And I'm just sitting here thinking, I've had so many conversations over the years with people about this concept. What do you think? How do you feel? And we live in a world that's moving so much faster. I mean, that you just really have to try and take the emotion out of it, or you end up just getting clobbered. You gotta rely on the data, because it's hard it's easy to get swayed by very emotional arguments that really don't have any concrete data behind them.
Mhm.
I mean, that's just the world that we live in. TikTok, Reels, wherever you're getting for your short form video, you're not getting actual data. You're getting about 2 bits of data and 1,000 bits of opinion on somebody that, well, if they had a bunch, some of them have money, some have never even played the game, right? They just report on it. And so I think it's really critical to have a really data driven approach, because that's how you get a repeatable, consistent process. Doesn't happen if you're just kind of going by your gut.
Great words to end on, Dean. The boss, always great to have you in studio with us. I'm Dr. Brock for Kimball Creek Partners, and I hope that this conversation pays dividends.